Employee compensation, post-employment, and share-based. Defined benefit pension plans are a little more complicated, and most of this lecture is based on DB pension plans. Here is a central point. Both IFRS and US GAAP require the funded status to be reported on the balance sheet. The funded status is equal to the present value of the defined benefit obligation minus the fair value of plan assets. So if a company has a future obligation and the present value of that obligation is 100 and the fair value of plan assets, so to meet this obligation the company sets up a fund. The fair value of that fund, let's say, is 80, then the funded status is 20, and this is a net pension liability. On the balance sheet, we will show this number. The footnotes will show the present value of the DBO and the fair value of plan assets. We can also have another situation where the present value of the defined benefit obligation is 100 and the fair value of plan assets is 120. Here we have a plan that's overfunded. So we can say that the funded status is 20, where the 20 is a net pension asset. Sometimes a convention is used to show the net pension asset as a positive number and the net pension liability as a negative number. Other terms that you might come across are overfunded or underfunded. This is an example of an underfunded plan because the liabilities are more, and this is an overfunded plan where the liabilities are less than the fair value of plan assets. Also keep this note in mind: the amount of reported assets is subject to a ceiling defined as the present value of future economic benefits, such as refunds from the plan or reductions of future contributions. So this note only applies where we have a net pension asset, and what is being said here is that there is a cap on this number, and that cap is equal to the value of future economic benefits. Let's consider some examples. The present value of Appalachian Corp's defined benefit obligation is 5,000 and the fair value of the pension plan assets is 4,500. What amount will Appalachian report on its balance sheet? So the plan asset is 4,500. The liability, or this present value of the obligation, is 5,000. Notice that the liability is higher, so this company will report a net pension liability of 500. Next, the present value of Everest Corp's defined benefit obligation is 5,000. So here again the liability is 5,000. The fair value of the plan assets is 5,500. The present value of available future refunds and reductions in future contributions, so in essence the present value of the benefit, is 700. This is the cap. Here the assets are greater than the liabilities, so we do need to consider the cap. The difference between assets and liabilities is 500, which is under the cap. So we can show a net pension asset of 500. Next, K2 Corp has a defined benefit obligation of 5,000. The fair value of pension plan assets is 5,900. The cap is 700. Here the difference between assets and liabilities is above the cap, so the number that we must report here is 700. The net pension asset then is 700. Now I want you to do example 1 from the curriculum. On this slide, we'll talk about the pension obligation, interest cost, and current service cost. The pension obligation is the obligation of a company at a given point in time. So to come up with the pension obligation, we figure out the future obligation of the company and then calculate the present value. The interest cost is for a given period, and this cost is going to be equal to the pension obligation at the start of the period multiplied by a rate. And the current service cost is the pension related cost to a company because of an employee's service during the period. Another way of looking at it is the change in pension obligation because of the employee working during a period. Let's understand this through a very simple example. A company has one employee with a current salary of 100, which will remain unchanged. At the end of 3 years, a lump sum pension payment will be made based on the formula number of years worked times final salary times 0.25, and the discount rate is 10%. So here, the amount that is due after 3 years, if the employee works for all 3 years, is 75. So this is time 0, where we are initially, end of year 1, end of year 2, end of year 3. And this 75 can really be thought of as 25 times 3, because at the end of the first year, the employee will have earned 25. At the end of the second year, the employee will earn another 25. And at the end of year 3, the employee will have earned this total amount of 75. Now, for every year, what is the interest cost and what is the service cost for that year? This table shows the numbers. At this point in time, the employee has not worked, so he has not earned any pension benefit. Therefore, the obligation is 0. The interest cost is also 0 because any rate times 0 is 0. The current service cost can be thought of as a plug because we need to calculate the pension obligation at the end of the year. At the end of the year, the company owes this employee $25, but this $25 will be paid after 2 more years. So we calculate the present value, which is 25 divided by 1.1 squared, which is 20.66. So we can say that the change in pension obligation because of the service given in this period is 20.66. 20.66 then becomes the opening obligation for year 2. Now, since we do have an opening obligation, there is an interest cost for year 2. That interest cost is 10% times 20.66, which is 2.07. What about the current service cost? There are 2 ways of coming up with this. One is to say that at the end of year 2, the pension obligation is now 50 divided by 1.1. Why 50? Because by the end of year 2, an employee has earned $50. And we need to take the present value of 50, which is 50 over 1.1, which is 45.45. So we are going from 20.66 to 45.45. Of this, 2.07 represents an interest cost. The rest, which can be a plug, is 20.73. So this is the current service cost. Another way of coming up with this number is to say that over this year, the employee earned 25. So the present value of 25 at this point in time is 25 divided by 1.1, which is 22.73. This closing obligation at the end of year 2 becomes the opening obligation at the start of year 3. The interest is 10% of this, which is this number. The current service cost is 25 because over this year the employee earns another 25, and since the employee is now at the end of year 3 when this is due, the amount that we take is 25. The closing obligation is the sum of these three, which is 75, or it is simply the amount that the company now needs to pay. Notice that in this example we said that 75 is to be paid at the end of year 3, and then we broke that 75 into 25, 25, 25, 3 equal parts. This method is called the annual unit credit method. Another point is that in this very simple example, we've just assumed an obligation. We've not assumed any plan asset. And since we are only calculating the interest cost for an obligation, we call this interest or interest cost. Later, when we also deal with a plan asset or a pension asset, and there is income on that asset, then we look at a difference between the interest cost and the interest income, and that difference is called the net interest income or the net interest expense. Now I want you to do a small exercise. On the previous slide we assumed a discount rate of 10%. What happens if the discount rate increases to 12%? So I want you to complete this table assuming an interest rate of 12%. I also want you to comment on the impact of an increase in salary. On the previous slide we assumed that the salary remained the same, but what if the salary increases? What will happen to the pension obligation, and what will happen to the interest cost and the service cost? Here is what you should get. In our initial case where the salary is the same but the discount rate has gone up, here are the numbers you should get. Opening obligation obviously is 0. The interest for year 1 is 0. The current service cost, now this number goes down. We can understand this by saying that the closing obligation is lower. So this number now is the $25 earned at the end of year 3. But this 25 is being discounted now at 1.12. So we'll say 25 divided by 1.12 squared, and that will give us 19.93. The service cost is the amount by which the pension obligation changed because of the service in that period. Similarly, we can calculate the numbers for year 2 and year 3. Note that the interest cost in this particular case went up a little. That is because the rate has gone up, and even though this rate is being multiplied by a smaller number, so the number is 19.93, but the rate is higher, so this number is a little higher. If we have a situation where the pension obligation is far out in the future, then the increase in rate will have a big impact on this pension obligation, so it is possible that the interest cost might also go down. The impact of an increase in salary is fairly obvious. If the salary is higher, then this number is going to be higher. If that number is higher, then the opening obligation and closing obligation will be higher. Also, the service cost is going to be higher. Now I want you to work through examples 2 and 3 in the curriculum. Before we move on, I want to cover a few key terms with you. The first is fair value of plan assets. Now this is something we've touched before. As we've discussed, a company has an obligation in the future, and our previous example just focused on that obligation. But to meet that obligation, we need assets. Those assets are called plan assets, and on the balance sheet, when we come up with the net pension asset or liability, the value of plan assets is actually the fair value. So if we have a fund and the fair value of that fund is 100 million, then that's what we are talking about here. Next point is expected return on plan assets. So at the start of period 1, we might have a fair value of 100 million. Under US GAAP, we need to have a number which represents the expected return on plan assets. So if that number is 10%, then at the start of year 1 we will say that the expected return on plan assets is 10%. 10% of 100 million is 10 million. So we are expecting a return of $10 million on our plan assets for year 1. The actual return on plan assets is what we actually get over year 1, and that number is only known at the end of the year. So if at the end of the year our assets have gone up to 115 million, then the actual return on plan assets is 15 million or 15%. Actuarial gains and losses. These are the gains or losses resulting from changes in actuarial assumptions. So if initially we assumed a discount rate of 8%, but we then change the assumption and use a discount rate of 9%, the impact because of this change will be shown as a gain or loss. Under US GAAP, the difference between the actual return and the expected return, so in my earlier example that was 5 million, this is also shown under actuarial gains and losses. And the final key point is that an increase in pension obligation resulting from changes in actuarial assumptions is considered an actuarial loss, and a decrease is considered an actuarial gain. So if we use a discount rate that is lower, so let's say we started out with a discount rate of 8%, and then this discount rate is reduced to 7%. This will result in an increase in the pension obligation, and that will be a loss or an expense. The pension obligation and pension cost is based on several assumptions. The most important one is the discount rate. This is the rate at which we discount future obligations. So this rate also helps us calculate the service cost and the interest cost. You need to remember that the discount rate used by a company is generally based on high quality corporate bonds. So if in a given country the YTM on high quality corporate bonds is 6%, then this would be the rate to use in the pension calculations. Another important assumption is the rate of increase in compensation levels. The reason is simple. Typically, pension benefits are based on the final salary of an employee. So if it is estimated that an employee has another 10 years of service left, then the estimate of how much he or she will be earning at the end of 10 years is based on an assumption about the increase in salary. Expected return on plan assets, this is only used in US GAAP, and we'll see examples later on how this number impacts the cost reported in the profit and loss statement. Length of service is important, and again I'll use this picture. If we are assuming that employees will stay with the company for a long time, then the pension obligation and the pension expense will tend to be higher. The pension benefits are accumulated over time, so the longer the time that employees spend with the company, the higher the pension obligation and pension cost. So if a company is making pension payments after a person retires, and let's say these payments are till the person is alive, then obviously the longer he lives, the higher the payments made by the company. So companies need to estimate how long people will live, and if the assumption is that people will live for longer, then the pension obligation will be higher. Employee turnover. If there is high turnover, then the pension expense is going to be lower. This is because if the turnover is high, then employees will not be accumulating pension benefits. Companies with post-employment healthcare plans disclose assumptions about healthcare costs. So if a company is saying that after the employees retire, they will continue to receive healthcare benefits, then obviously the value of that benefit depends on the cost of healthcare. So companies often assume that healthcare costs will rise at a certain rate in the short run. So a company might say that for 5 years time, the healthcare costs will rise at 10%, and then after that, the cost will rise at 6%. This 10% is the near-term increase in healthcare costs. This is the long-term trend rate in terms of healthcare costs, and 5 years is the time where we go from 10% to 6%. So if a company assumes a high near-term increase in healthcare costs, that increases the value of the obligation. Similarly, a high number here increases the value of the obligation. And this point where we switch from 10% to 6% also impacts the value of healthcare costs. So if we assume instead of 5 that the 10% trend will continue for 7 years, then that increases the present value of the obligation. Now I want you to try example 4 from the curriculum. Here we look at the impact of the 3 most testable assumptions. I've already talked about a higher discount rate, but let's go a little deeper. If we initially used a discount rate of 10% and then increased this to 12%, that will reduce the obligation. So if we look at our funded status, the funded status is calculated based on the present value of the pension obligation and the fair value of plan assets. When this number goes up, the present value of the pension obligation goes down. The fair value of plan assets is not impacted. So a higher discount rate is going to lower the overall obligation. In terms of the pension cost, you might recall that we talked about an interest component and a service cost component. There are other components also which make up the overall pension cost, but the 2 most important ones in the context of the discount rate are the interest component and the service cost. The service cost is clearly going to be lower. The interest component depends on the opening obligation and the discount rate. If we use a higher discount rate, the opening obligation will be lower, and this is being multiplied by a rate which is higher. So typically, if the obligation is very far out in the future, then this impact dominates. Generally, the periodic cost will be lower because of lower opening obligation and lower service costs. So we are saying that generally when we use a higher rate, then the periodic pension cost comes down. The higher rate of compensation increase results in a higher obligation and a higher service cost. Higher expected return on plan assets. This has no impact on the plan assets because with plan assets we are using fair value. The higher expected return on plan assets is not used under IFRS. With US GAAP, it will result in a lower pension expense on the income statement, and we will see an example of how this works. When comparing the pension disclosures of different companies, we should consider the following. Number 1, differences in key assumptions. If we have 2 companies A and B which are in the same industry and in the same region, then ideally the assumptions should be similar. So assumptions related to discount rates or assumptions related to the increases in salaries. If these assumptions are different, then adjustments need to be made. Another item to check is whether the assumptions are internally consistent. So if we have a company which uses a discount rate and the assumed inflation or the expected inflation in that discount rate assumption, let's say, is 4%, but when evaluating the increase in salaries, the assumed inflation rate is 3%, then this would mean that there is an inconsistency which needs to be looked into further. Number 2, we should keep in mind that the amounts disclosed on the balance sheet are net amounts, and this impacts ratios. So going back to company A and B, it's possible that both are showing a net pension liability of 5 million, but it might be that with company A, the total liability is 100 million. This is the pension liability, and the plan asset is 95 million. Whereas with company B, the liability is 25 million and the asset is 20 million. So in terms of the net pension liability, it is 5 in both cases. But when we look at ratios such as debt to equity and so on, then there will be a major difference if we simply use 5 and 5. Ideally, when calculating such ratios, we should consider the overall liability number and the overall assets number. Third point, the periodic pension costs recognized in the profit and loss statement may not be comparable. This is something we'll see in detail later, but very briefly, under both IFRS and US GAAP, the total pension cost for a given period is typically the same, but this total pension cost is allocated between the P&L statement and other comprehensive income. And this allocation is different between IFRS and US GAAP. So we can't simply take the pension expense from the P&L for an IFRS company and compare that number with the pension expense in the income statement of a US GAAP company. And the fourth point is that the cash flow information may not be comparable. So certain pension related cash flows might be shown as financing activities in IFRS, whereas in US GAAP, those same cash flows might be shown as operating. Under both IFRS and US GAAP, the amount disclosed on the balance sheet is the net pension asset or the net pension liability. An analyst can adjust a company's assets and liabilities for the gross amounts of the benefit plan assets and the gross amount of the benefit plan liabilities. This information is available in the footnotes. And this adjustment is particularly important when we are coming up with debt ratios or leverage ratios. The total periodic pension cost represents a company's overall economic cost during a period. Now, this is referred to as the total periodic pension cost. Sometimes it's called the economic cost during a period, and we'll discuss this in detail later, but in very simple terms, this overall pension cost is equal to the funded status at the end of the period minus the funded status at the start of the period. So that's the change in funded status plus any employer contribution. So this overall periodic cost or the overall economic cost is partly shown in the profit and loss statement, and there are some components that are shown in OCI. As I mentioned before, the IFRS and US GAAP treatment is different. Now let's get into the pension cost disclosure under IFRS. An important component of the pension cost is the service cost. Under IFRS, this is recognized in the profit and loss statement. So let's say for a given company, we have the information presented for 2015, and in the footnotes, we will be able to find the service cost. So this is covered in the expense shown in the profit and loss statement. Another component is the net interest income or net interest expense. This is recognized in the profit and loss statement, and it is calculated as the net pension asset or liability times the interest rate. In our example here, these are numbers at the start of the year. So the present value of the defined benefit obligation is 140. The fair value of the plan assets is 20. So we have a net pension liability of 20. To come up with the net interest expense, we take the net liability and multiply by the discount rate. So it's 20 into 10%, which is 2. This is an expense because we have a net pension liability. If we had a net pension asset, then we would call this the net interest income. Another IFRS component is remeasurements. This is the net return on plan assets and any actuarial gains and losses. So there are two parts, A and B. A is the net return on plan assets. This is equal to the actual return over the year. So in our example for 2015, these were the values for the obligation and the fair value of plan assets at the start of the year. So fair value of plan assets at the start of the year was 120. Let's say that this number grew from 120 to 135, and let's also say that there were no contributions to the plan. So the actual return was 15 million in dollar terms. So that's the number over here, the actual return, which is 15, minus the plan assets, which is the plan assets at the start of the year, 120, times the interest rate, which is 10%. So in this simple example, the net return on plan assets would be equal to 15 minus 12, which is 3. And the reason we do this subtraction is the 120 into 10% is already factored over here. So recall that we had a net pension liability of 20, which was 140 minus 120. So since we've already considered 120 times 10% over here, that impact is being subtracted. In our case, the actual return is more than this number by 3. So this 3 is reducing the pension expense. Actuarial gains and losses, this is the change in a company's pension obligation arising from changes in actuarial assumptions. So here, if we say that this number is 4, then let's talk about what is shown in the P&L and what is shown in OCI. Service cost of 7 is shown in the P&L. The net interest income of 2 is shown in the P&L. So the total pension expense shown in the profit and loss is going to be 9, 7 plus 2. In OCI, we are going to show 3 and 4, which is 7. US GAAP does things slightly differently. For one, service cost is broken into current service costs and past service costs. The current service costs is the amount by which pension obligation increases as a result of employees' services in the current period, and according to US GAAP, this is recognized in the profit and loss statement. Past service costs, this is the amount by which pension obligation relating to employees' service in prior periods changes as a result of plan amendments or plan curtailments. This number, the past service costs number, is recognized in other comprehensive income and subsequently amortized to the P&L over the service life of employees. Interest expense on pension obligation, this is recognized in the P&L, and this number is simply equal to the discount rate times the pension obligation at the start of the period. The expected return on plan assets is recognized in the P&L, and this is equal to the plan assets times the expected return on plan assets. And I mentioned this earlier, the concept of expected return is used under US GAAP. We do not see this expected return item in IFRS. So if the plan assets at the start of the year were 100 million and the expected return is 7%, then this number would be 7% of 100 million, which would be 7 million. This 7 million number reduces the pension expense. And finally, actuarial gains and losses, including differences between actual and expected return on plan assets. This component can be recognized in the profit and loss statement, but it is much more common to recognize this component in OCI, and subsequently amortized to the P&L using the corridor or faster recognition method. From an exam perspective, typically you are going to see this scenario where the actuarial gains and losses, as well as the differences between the actual and expected returns on plan assets, you'll typically see that this is recognized in OCI. But from the OCI, this is subsequently amortized to or transferred to P&L using one of these two methods. And all you really need to know is that these two methods exist. It is highly unlikely that you will be tested on the details of these two methods. You do, however, need to know which components go into the P&L and which components go into OCI. On the exam, for this component, you will be told whether it's going to the P&L or to OCI. This part, difference between actual and expected return on plan assets, is shown over here. So the actual return might, let's say, be 15 million, and from that we subtract the plan assets at the start of the year times the expected return. If this expression is 10 million, then the difference is 5 million. If the actual return is higher than this number, then that reduces the pension expense. Actuarial gains and losses, this basically is the change in a company's pension obligation arising from changes in actuarial assumptions. So this is similar to what we have in IFRS. If you found this lecture helpful, then I'll be very grateful if you can do three things for me. Number one, like this video. Number two, like my Facebook page. And number three, visit analystforum.com and there add my logo to your studying with profile. You can see this slide for help on how to do that. Thank you very much and good luck with your studies.